Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week, we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
My guest today is actually me, your humble host, Clay. On this episode, you will hear me interviewed by Rob Paone, the host of the Crypto Bobby podcast and founder of Proof of Talent, which is a boutique recruiting firm that helps companies fill positions in the blockchain and cryptocurrency space. A few months ago, Rob interviewed me for his podcast, and I liked the content so much that I asked Rob if I could air a modified version of that conversation here for you today. He generously said yes, so here we are. By the way, this is the second time that I've been on Rob's show. See the show notes for links to the previous episode we did together. Anyway, you're probably used to me being the one asking the questions. In this episode, we flip the script, and I hope you enjoy what happens when the tables are turned. In this conversation, Rob and I discuss 1, how and why exchanges spam aggregators like CoinMarketCap. 2, what ticker stuffing is and how it works. 3, why referring to fake volume as wash trading isn't an accurate description of the problem. 4, why liquidity providers that are really just providing volume as a service to exchanges and crypto projects are hurting the space. And 5, what the crypto data ecosystem needs if it really wants to grow up. We'll get right to this content in just a second, but before we get started, I'd like to pause for a moment to tell you that this episode is brought to you by the good folks at Nexo. Here's a word from them. Nexo is the only lender offering instant crypto credit lines, which let you use digital assets as collateral to get cash in 45 fiat currencies and stable coins. Nexo is a strategic partner of exchanges, OTC desks, and crypto funds throughout its portfolio of structured financial products. Institutional counterparties can earn up to 8% annually on their idle stablecoins, enter into asset swap agreements, or directly borrow crypto. Individuals can also park their cash in stablecoins at Nexo's interest earning account to get an annual return of 8%. What's more, interest is paid out daily and you can add or withdraw funds at any time. So if you're looking to borrow, lend, or swap digital assets, Nexo is your go-to partner. Definitely explore nexo.io, or if you're an institution, you can reach them at institutions@nexo.io. And as a side note, I really like this team. I recently had the opportunity to speak to one of their co-founders, Anthony, and just had a really great and inspiring conversation about the future of crypto-backed loans and interest earning accounts. So again, check them out at nexo.io. This episode is also brought to you by the Nomics API and CSV data export service. If you need an enterprise-grade crypto market data API for your fund, smart contract, or app, or if you need historical CSV dumps of trading data or crypto market cap data from top exchanges or even obscure ones, then consider trying out the Nomics API or our historical data export service. Our cryptocurrency API enables programmatic access to clean, normalized, and gapless primary source trade data across a number of cryptocurrency exchanges. Instead of having to integrate with multiple exchange APIs of varying quality, you can get everything through one screaming fast fire hose. And if you'd like to order historical cryptocurrency data as CSV exports from top exchanges, email us at sales@nomics.com. Okay, back to our regularly scheduled program. Here's my conversation with Rob Paone. Enjoy.
Clay, how have things been in the past almost year since we last chatted?
Things have been great. You know, we continue to grow in traffic and Alexa rank. And I think the consumer side of things has always been fun for us, but our bread and butter is the data business. And that's been going really well. You know, we've learned a lot more about the needs of high frequency traders in the space and people using a variety of different strategies. I think when we came into the space, we were so new, nobody knew who we were. And so the only customers we were getting were people with like these really niche, obscure data needs. And, you know, because of our data set and how it works, we were able to meet those. And it's nicer to have a little bit of broader exposure now.
Awesome. It's been cool to see you guys continuing growing at Nomics. But I think one of the things that we've been talking about a lot lately and has been brought to light, at least like from an industry perspective, I think a lot of people behind the scenes knew was happening. But one of the big things that really pushed this topic of conversation forward was the Bitwise report that came out that really kind of unveiled the curtains a little bit on what was happening on some of these cryptocurrency exchanges and got the industry talking. Would love to have your take at a high level about kind of what that Bitwise report was about and just your general thoughts on it.
Hey, this is Clay cutting in to give you some context about the Bitwise report. On March 19th, 2019, Bitwise, which is a crypto asset management firm, filed a report with the U.S. Securities and Exchange Commission in the hopes of getting their Bitcoin ETF approved. In the report, Bitwise asserted that 95% of exchange volume was fake and only 10 exchanges had quote unquote real volume. This report spread like wildfire throughout crypto Twitter. Okay, back to the show. First and foremost, I think this report did so much for the industry and really kind of kicked everyone's ours included. It's a really positive thing. So they said a couple of things that were really interesting. The first thing is that they said, which was kind of shocking, is that there were only 10 exchanges that had actual volume. That needs to be qualified a lot. So first off, they don't actually define what actual volume is, but the implication is that there's only 10 exchanges that don't have a preponderance of fake volume. So what did they look at in this Bitwise report? So they looked at exchanges that had Bitcoin volume. So as far as we know, they were only looking at exchanges with order books. So like local Bitcoins wouldn't count, and like Shapeshift wouldn't count because they don't have centralized order books. So exchanges with order books and on those exchanges, they looked at exchanges with BTC to Tether or BTC to USD pairs. So they weren't looking at the entire universe. They weren't looking at decentralized exchanges because most of those they just have ERC20 and Ethereum trading. So they just look at these specific Bitcoin markets on centralized exchanges, and they only looked at the top 81 exchanges on CoinMarketCap. So there's a lot of sort of filters on what they looked at, but still the overwhelming evidence here is that wash trading is rampant. Volume as a service is rampant. A lot of these services being provided by liquidity providers or market makers. A lot of this there's definitely a seedy underbelly to not only what's happening on these exchanges, but the world of spam. So the first finding was only 10 out of 81 exchanges had real volume. I question a little bit that there's just 10. There appears to be a little bit of base 10 bias, like why not 9 or 11? 10 seems kind of convenient. They reported that on the BTC to Tether and BTC to USD pairs, 95% of volume was fake. It's interesting. It's a cool report. There's a lot you can learn from the report about how fake volume works, but this rabbit hole goes so much deeper.
Let's get a little bit deeper on that. There are maybe only a handful of these 90 exchanges that were looked at that are actually really trading crypto or Bitcoin specifically. But then I'm sure a lot of that also applies to a vast number of altcoins, maybe even more so than of the altcoins too. When you look at it, how is this taking place? What is going on that is driving this fake volume? I know one thing you mentioned was this liquidity as a service. These market makers, what is happening on these exchanges that just produces all this fake volume?
I think the first thing that we need to do when sort of considering what's happening here is to start using the name spam. People are referring to wash trading or toxic activity and all kinds of maybe sublimated terms, but this is, at the end of the day, this is spam. And a lot of what's happening here is people gaming the system so they can get to the top of the CoinMarketCap rankings. So a couple days ago, I was at CoinMarketCap. I was looking at the list of top exchanges, and everyone says, it's like Binance is the top exchange. And I couldn't see Binance in the top 10. Now it looks like they've done some things to improve it there. But most of the exchanges that I saw on the exchange rankings were exchanges that I've never heard of, or I could call everyone I know and they could call everyone they knew, and nobody has ever placed trades on these exchanges. So why is this spamming happening? There's a lot of reasons. When an exchange is at the top of the list, first and foremost, they get traffic. So a lot of these aggregators link directly to the markets pages for these, for trading pairs. So it generates traffic for them. And in some cases, it can become a self-fulfilling prophecy. You spam your way to the top of the list, you get more traffic, there's more liquidity, and you start getting maybe more organic trading happening on your platform. Another reason is when they're at the top of these lists, they can charge huge listing fees to ICOs. They can run IEOs for coins. This is something we're seeing a lot more recently, where exchanges like Binance will take a cryptocurrency project, they'll handle the public offering and charge a cut. And often they're making 7 figures plus, for these types of deals. There's a lot that they get out of this. When exchanges rank higher on, let's say, CoinMarketCap, now they're on the first page of the exchange index, which means that they're more likely, that the link that they get from CoinMarketCap is more valuable from an SEO perspective. There's so many reasons why they might do this. Free advertising. There's a lot going on here. I was thinking about what this is. At the end of the day, what should this be called? And I was like, I don't want to call this wash trading or toxic activity. I was like, this is exchange spamming. And there's a subset of exchange spamming called volume spamming. And there's a subset of volume spamming that I'm calling ticker stuffing. For those of you who don't know what a ticker is just kind of like the candle. So what we know is candles typically have these defined boundaries. But what CoinMarketCap and other aggregators generally ingest for the most part are ticker feeds. And tickers are like a 24-hour candle that ends whenever the exchange decides it should end. So it doesn't end at like the end of the day or, on minute boundaries. It just ends whenever it's computed. It's timestamp of computation, open, close, high, low, and volume. And you can literally, if you get good at this, you can literally just go in and take that volume numbers. You've got open, close, high, low, volume, and you can just change it. You can just like add, you can say like, hey, whatever the figure is, like add $1 billion. And send that right over to CoinMarketCap or whoever, and just pump up your volume. So the easiest way to do this is ticker stuffing, and you're just shoving volume in that candle. There's a lot of other ways that it's done as well, but ticker stuffing is probably the most frequent thing that we see.
When I look at this, part of me thinks like it's a problem for the industry because a lot of people pull data from CoinMarketCap. So they'll go and they'll point to, oh wow, the volume for Bitcoin today was $30 billion. Volume for whatever was X billion dollars or $1 million. And maybe they'll make some type of decision off of that. But then part of me thinks, are retail traders or even institutions as well, or maybe just quote unquote more sophisticated traders, are they taking this data from CoinMarketCap and really falling for a lot of this stuff to like, that's something you said where maybe it becomes a self-fulfilling prophecy where you have F-Coin or whatever random exchange, basically transaction mining or big voluming their way to the top, and then they actually get users? Or is this just something where, maybe they're at the top, but you'd hope that people are actually looking at this and being like, well, I've never heard of this exchange once in my life. I'm not going to actually trade there.
What we've seen from our institutional customers is they've known about this happening for a long time. They're not believing the volumes. They're only trading on places that they trust. But I think the average consumer is probably the one that's suffering here. There's a lot of ways it can hurt you. So I don't think this fake volume generally for the higher market cap coins moves the price a ton. It doesn't look like it moves the price a ton. As you get further down, this volume can, especially if assets are being priced on a volume weighted basis. But there are a lot of ways that retail investors can get screwed. The first one is that they see all this fake volume and they assume that an exchange has liquidity, right? That they're going to be able to put forward a significant buy or sell order. Maybe if they're like, hey, I want to take X number of dollars from my retirement or X percent of my retirement, I wanted to put it in Bitcoin, and they put through a trade and those order books just aren't as deep as they look. I think the second thing is that, when you see a top exchange on a place like CoinMarketCap, you might assume that it's secure, right? It's a reputable exchange. It's a top exchange on this listing. I mean, people have sort of similar assumptions when they go to Google and they search for loan, right? Like they just assume that Google's not going to put at the top of the list. I think another aspect of this is it, when you're at the top of the listings, there's a certain amount of social proof that comes with that, right? If you're at the top of the listings day after day after day, those rankings mean something, especially when a site is the top site in the space. I think that's mostly how the space is affected, is it's affecting retail investors, and institutions aren't falling for this.
If I'm a retail trader and I'm new to the space, how do I protect myself from the issue of fake volume? What do I look out for? Where do I look for data that isn't plagued with all this nonsense and kind of wash trading and just...
I guess here's a part where I'm going to shill a bit. At nomics.com/exchanges, we have a list of exchanges with highly transparent data practices. And the impetus for this, like a lot of other aggregators work in this area, really comes from the Bitwise report. So when the Bitwise report came out, the first thing that we asked ourselves was, what do the good exchanges, what do these 10 good exchanges have in common? And what we noticed is that of the 10 that Bitwise explicitly kind of blesses as being good, of course that's stuck in time, and the day after the report came out, one of them could have become a bad actor, multiple ones could have become bad actors. But what do these 10 exchanges have in common? And what we found was 8 out of the 10 exchanges that Bitwise bless provide full trade history. So not only are they providing the most granular, the highest granularity trade data available, but they're providing that data available back to the inception of the trading pairs on those exchanges. And that's, of course, no guarantee that they're not faking that data. But, we kind of think about this like an IRS audit. If you were being audited by the IRS, you probably wouldn't want to give them every receipt. You'd want to give them kind of aggregate summary reports on your financials, and you would want to give them the least amount of history possible. So, something like summary level data for maybe a year or two. If you start giving them receipts and you go back, since the very beginning of your spending on all your accounts, they're going to find stuff that you didn't even find. There's probably going to be things you did that you didn't report, even if it's not on purpose. So we found that 8 out of 10 of the good actors are providing this super high quality data. And then when we looked at the exchanges that Bitwise called out as doing a lot of bad things that were obviously not good, we found that all of those exchanges, so they explicitly called out 16 as doing not great things, but the assumption is all the others are doing bad things too. But of the 16 that they called out, 14 of those 16 only provide ticker data with no history. So the worst form of data possible with no history, whereas the good actors were the high granularity data with full history. So we created our exchange ranking index where we sort first by the transparency of these exchanges, and then we sort by volume. So Binance is usually at the top of the list. OKX is not at the list because they don't provide a lot of transparency in general. These exchanges are all exchanges you've heard of. If you go to our exchange rankings, you'll see exchanges that you've heard of for the most part. Probably exchanges you've made trades on and stuff, like Coinbase, Binance, Kraken, Poloniex, Gemini, etc.
So looking at the ranking right now, we have on the top Binance, BitHum, Coinbase Pro, Kraken, Bitstamp, Poloniex, Ethernex, Gemini, Bitflyer, a lot of the ones people have heard of. And on the bottom, we have Mercatox, Coinbene, Itbit. Itbit's interesting with the D. Maybe you could speak a little bit of that, because I think Itbit is Paxos, and maybe Itbit was actually, if I'm remembering correctly, Itbit was actually listed in the Bitwise report as one of the 10 trusted exchanges. Is it more of a data kind of issue there with them?
I think that's important to note here. When we put out these rankings, a lot of people came to us and they told us about maybe exchanges that we labeled as a D in terms of transparency, but maybe they thought were good actors. And then there are other exchanges that have done things, maybe they had bad customer service or someone had a bad experience, that we labeled an A. And so, we've been very clear that this is an exchange transparency ranking. This isn't a overall, all your business practices are great. So ItBit we're actually in conversations with them about their data transparency practices. And we expect that within a few months here, we'll be able to get much, much better data from them. So we think they're going to bump up the rankings. But yeah, ItBit right now only provides ticker data, and they don't provide really any history at all. That's why they're there. And then there's some, we have some obscure exchanges that have an A rating, but they've got really fantastic data practices. So that's why they're there. Whereas, if you go to like CoinMarketCap right now, they've cleaned some things up a little bit, but you've got like CoinEal is number 4. I have no idea what CoinEal is. I really have not even heard of it.
Not real.
Yeah, I don't think it's a real exchange. You've got ZBG in there. You've got CoinBene was like the quintessential bad actor in the Bitwise report. Like if there was a villain in the Bitwise report, it was sometimes I call it CoinBean. I'm like, is that CoinBene or CoinBean? I have no idea. So CoinBene was like the villain of the Bitwise report, and CoinMarketCap has it as their like number 9 exchange. Bitwise put out another report, a full white paper where they mentioned that Fcoin was the top exchange by volume on CoinMarketCap in April. And yesterday I was on CoinMarketCap and they had an ad for Fcoin. I was like, wow. And the ad was speaking to their trading volume. It was like, wow, we have the X number of Bitcoin are transacted per day on our exchange, according to CoinMarketCap. And I was like, this is a huge conflict of interest. I think it's a lot like email spam back in the day. So way, way back in the day, people would just buy these CDs with email addresses and they'd spam everyone. And it would say things like, porn or Viagra or whatever they were selling. And then folks like Gmail came along and they said, all right, anything with these words, with this density, we're going to flag and put into the spam folder. And then the spammers were like, okay, we're just going to use an 0 instead of an O in porn. And, we're going to swap out these characters. We're going to use a 1 instead of an L. And then Gmail caught that, and then they came back again and they're like, all right, we're going to put the entire message in an image, and that way we can say whatever we want. And then Google started looking at the ratio of text to images, and it's just an arms race. And so folks have asked me like, how are you going to fix this? And I don't think this is a one and done thing. I think this is going to be a constant process. That's why we've got a spam team here at Nomics. It's never going to be fixed. People are going to get more sophisticated over time, especially when you consider how decentralized the space is. The fact that anyone can, with like 0x, start up an exchange basically in a weekend. We're going to have security token exchanges, non-fungible exchanges. We're going to have local exchange. I mean, I think we're just going to see more exchanges, and this is going to be a harder and harder problem to spot over time. Tons of trades going through, but flat order books, or sometimes we see these, huge order books and, very little trading volume. And then sometimes we'll get the trades from an exchange and we'll add up all, when we know we have gapless data. So some of these exchanges they'll give each trade a unique identifier. So each trade increments by 1. And so we actually know that we have all the trades that have happened during a day. And then we'll see the candles that they'll send over, and the candles will have like a gajillion dollars more volume than the individual trades added up. Or what's another thing that we see? Sometimes we'll see, if there's a bid spread, sometimes we'll see these bids leap across, like pole vault across the ask, and some order will be filled like way out of market, something for some ridiculous price for some coin, and that order will be placed. It's like, how does a matching engine even make that happen? You can't snipe off orders from the order book. I mean, you can on some decentralized exchanges, but just it's just like amateur hour right now. You could do anything and get away with it.
I mean, I think it's pretty clear at this point in time that there is a lot of shenanigans, a lot of bad things happening in the crypto space from an exchange perspective. But you've been in the industry kind of working hand in hand with these exchanges for over a year now, really.
Hey, I wanted to pause for a second to let you know that this episode of the Flippening podcast is brought to you by Nexo.io. Here's a word from them. Nexo is the only lender offering instant crypto credit lines, which let you use digital assets as collateral to get cash in 45 fiat currencies and stablecoins. Nexo is also a strategic partner of exchanges, OTC desks, and crypto funds through its portfolio of structured financial products. Institutional counterparties can earn up to 8% annually on their idle stablecoins, enter into asset swap agreements, or directly borrow crypto. Individuals can also park their cash in stablecoins with Nexo in an interest-earning account to get an annual return of 8%. What's more, interest is paid out daily, and you can add or withdraw funds at any time. So if you're looking to borrow, lend, or swap digital assets, Nexo is your go-to partner. Definitely explore nexo.io. Or if you're an institution, reach out to them at institutions@nexo.io. Okay, back to the show.
What are some of the good exchanges doing outside of the data? Like how have things progressed in the past year where, things might actually be looking positive outside of the BS, fake volume, wash trading, like with some of the legit exchanges?
I think the main thing that seems to be changing is that these exchanges are starting to take their data practices a lot more seriously. So CoinMarketCap, as far as I know, was the very first aggregator, and all they required was a ticker feed because it's really easy to start ingesting data from an exchange with a ticker feed. It's like 5-6 data points. And so an exchange would get up and running, and the first thing they wanted to do when they were live to get distribution for their markets is it's like, hey, we got to throw up a ticker so we can get listed on CoinMarketCap. And that's smart in a lot of ways. With like the New York Stock Exchange and the NASDAQ, there's only really two big exchanges in the United States when it comes to stocks, and they have a monopoly on the data. They charge an arm and a leg for their data. But if you're a crypto exchange, a lot of times your data is like this distribution channel. It's a good way to advertise what your product is. And if your products are these trading pairs where you make some money every time a trade goes across them, it really behooves you to share data. So these exchanges at the beginning were doing the very bare minimum. It's like, CoinMarketCap needs a ticker feed. We'll give them a ticker feed. And then they would essentially after that, they would ignore their data altogether. Maybe at some point a market maker would come to them and say, we'd like order book data. So they'd come through and they'd just provide order book data snapshots or something through a WebSocket, but no historical order book data. And to this day, I can't off the top of my head think of one exchange that provides historical order book data. I don't think anyone does that. So what we're seeing is that data practices to a much greater extent since this report and since folks like us and others have done things to improve the state or to add some kind of filtering is exchanges are realizing that they need to do more than the bare minimum around data, and they need to provide an audit trail, and they really need to step up their game if they want institutional investors to take them seriously. The problem is that so many of these exchanges have been fudging data, and it's kind of like this, it's like this arms race of like volume spamming where it's like you have to, in order to be at all taken seriously, you have to get past everyone else who's also faking volume. I don't think we'll see anytime soon exchanges opening up full history, but they'll probably say like, hey, we're going to start on this date and moving forward, data is going to be available. I was talking to one exchange and I said, hey, like in order to give you an A rating, we need like full trade history. And they said, I'll never forget that. They're like, oh yeah, no, we just don't keep it. Are you kidding me? Like hard drive space is super cheap. He's like, yeah, it's too expensive. No, it's not. It's not too expensive. Like the hard part is not storing it. It's everything else. So I think they were probably just lying, and we get lied to all the time.
As somebody in the crypto blockchain world who sells your API to professional, sophisticated traders, institutional investors, whoever it might be, I'm curious as far as the past year or so, how have the conversations been reflective of the price? Has the recent bounce back in 2019, do you feel like that's brought more interest back into crypto or specifically into the data surrounding crypto? Or have the conversations for you remained relatively stable, kind of regardless of price, since it is maybe a more sophisticated class of trader that you're mostly speaking with?
Our website traffic has gone up with the prices, but the API business and the data business it's growing it doesn't seem to be correlated with prices. Like we were growing even when the market was down. We're just a lot like a utility company. It's this boring basics kind of business, and we're not seeing sales of the API rise and fall based on the market cap. Yeah, it's mostly correlated with like how good of a job we're doing marketing that business.
When you look at just kind of like where the market is going, what type of features or kind of functionality in the trading ecosystem do you think needs to come into place maybe outside of data? Obviously, yourself and other individuals are working to improve the level of the quality and the transparency of data for trading. But what else is there in the industry that needs to happen for this to just kind of continue to move in a more, let's say, professional manner?
I really think that the biggest products, we don't need another fork of Bitcoin. We don't need another fork of Ethereum or Zcash. What we need, I think, is Bitcoin infrastructure. I think the Lightning Network needs to grow. I think we need more and better ways to earn interest and to borrow, preferably in trustless ways against those assets. I think that it's just sort of the continued integration of really Bitcoin first and foremost into our daily financial lives. And it's happening. I think at the very beginning it was about these tokens, but I love what I see like Wire doing and folks like Nexo or other loan-based products. What Casa is doing with sort of these Lightning nodes in people's homes. I think it's more of that kind of thing. I don't know. What do you think?
I would echo those sentiments. Like, I think that it's been interesting to watch as the quote unquote bear market happened. I think it was a good cleansing of the space from a lot of either just bad actors or a lot of people that raised money with just no intention of actually doing anything with it. And then there were kind of a subset, I think, of people that continued to just kind of grind through it. And whether that has been on the Bitcoin side, like you said, Casa, I have a node kind of sitting a few feet away from me.
Hey, me too.
It's a pretty cool product. I like it. So whether it's kind of advancements with Bitcoin and with Lightning, or there have been a lot of the narrative around like DeFi with Ethereum has been pretty interesting to watch, whether that's like the growth in MakerDAO, CDPs, or compound finance and borrow lending, or the BlockFis and the Nexos of the world. I think there's just been a lot of kind of increased like utility of actually owning these assets, and the protocol development on the base layer of Bitcoin and the base layer of Ethereum on some of these other assets as well has been pretty good to watch. So I think all things being considered, I think the industry as a whole is moving in a positive direction, and it's just kind of people want things to happen quicker, because there is usually a price associated with basically everything in the industry, and it doesn't necessarily rely on any type of fundamentals at all. But it's something they kind of have to either have some type of long-term conviction and be patient on, or get out kind of.
If you think about the development of the internet, there was like, TCP/IP, and then HTTP, and then, HTML and CSS. And I think a lot of people are expecting, full-on startups that can do things like Uber and Airbnb. We're just not there. The tech stack is super, super, super early. We're still trying to get things like custody right. So I think the foundation is people's expectations is like they've just seen like Instagram come and then blow up, or we've seen all these things that have benefited from literally 2 decades of hardcore innovation on top of the internet, and we're only 1 decade in right now, so we don't have our Airbnb or Ubers just yet, but I think it's coming.
Yeah, and it's like if you had TCP/IP shares that you could publicly trade on a daily basis, 24/7, 365 too. It just adds in a whole level of complexity and removes, I think, a lot of any patience, and it gives the nice dopamine hit when you look at the charts and things like that. But it's very interesting in the short and I think long term too, just kind of how you can break down the perspectives and look at things for sure.
I think kind of something that's different during this bull market versus the last one is I think we've just got a lot more sophistication among institutional investors, but also among individuals. And I think the conversation that we're having about data is part of that. So, it's my understanding that there are so many more people that understand blockchain data and how blockchains work than understand how the exchange ecosystem works. We do this weekly webinar at Nomics where we go over like, here's an exchange, here's how a Bitcoin exchange works. Here's a market data 101. And we have people from like large banks and analysts that are like, didn't know how this stuff actually works. But more and more people do understand how this stuff works. When people come to us to buy data, the biggest problem we have is that people literally don't even know in many cases how to ask for what they want. They literally don't know how to specify what they're looking for, because there's a lot of similarities to, sort of traditional exchanges, but it's sort of this mix of like traditional exchanges and Forex minus regulation, minus quality controls. It's completely different, but I love seeing the infrastructure come together. I love to see, people's understanding of the space improve. I think we're well on our way. I don't think we're going to see like Bitcoin at, this is for entertainment purposes only. I don't think we're going to see Bitcoin at like $4,000 again. I think those days are long gone, fingers crossed.
I hope so. But yeah, I do tend to agree with just the commentary around, infrastructure. I think that when you look back at how primitive and just general a lot of the infrastructure was in 2017 that carried the entire crypto market to $800 billion. The exchanges and the level of support and basically everything about the market in 2017 was, whether it was centralized exchanges, they just weren't ready for it. Decentralized exchanges, the biggest decentralized exchange, really the only one at the time was EtherDelta. There are just so many more on-ramps and just such a broader variety of products and that have had really 2 years at this point in time, or a year and a half at least, to kind of like season out and flesh out a lot of the technical issues and as well as just people issues with support and kind of building that out. That's been good to watch. What kind of question that I'm a little bit curious on as far as working with the professional traders that you do that, receive data from these exchanges that you provide to them. Another area that seems to be pretty hot right now is on-chain data as well. I know that's not something that you necessarily do with Nomics, but are you seeing professional traders kind of utilizing some type of combination of the Nomics API with maybe something from CoinMetrics or from some other place where they're trying to utilize exchange data and on-chain metrics at the same point to just create better investments or better trading strategies?
It's still a pretty sort of niche data need. Most investors in the space don't have a highly reliable, in the sense that it like stands up to back tests, hypothesis about what to do with on-chain data. If there's more addresses, those could potentially be from the same people. So that could point to an increasing awareness in security or how Chainalysis is crawling the chain. So what do more addresses mean? What does transaction volume on the Bitcoin network mean? Does it mean that more people are moving their coins to exchanges because they're going to sell, or does it mean that they want to change it for, exchange it for something else? I personally don't know of more than like a handful of funds of funds with active strategies that have really robust hypotheses around on-chain data that they're willing to put a lot of money behind. I think that space is still somewhat new. And I think the further away you get from like just really Bitcoin and Ethereum, the less, predictability that kind of data has. If you go to like EOS or whatever, there's just the people are just making up transactions, and there's plenty of transaction or, blockchains where transactions are really, really cheap. And it's not necessarily clear what's happening when transactions are taking place. We're still not getting a ton of requests for on-chain data. In my opinion, there isn't right now a mature large market for on-chain data. I question whether or not a startup is going to generate enough capital with on-chain data to hire top talent and continue to grow. I think that space and that ecosystem is not yet very commercially viable. I think it's something that a lot of people want to look at, and it's like nobody wants less data, but in terms of people willing to pay cold hard cash in large amounts that would justify top engineers and continued R&D, I don't know that exists right now.
One thing you mentioned was Chainalysis and other types of those like blockchain analytics companies. Does that factor in at all to examining the kind of exchange data? Or is that more of like an outlier on-ramp, off-ramp type thing? I'm just kind of curious if that has any type of play into the perceived trustworthiness or quality of data, if any specific exchange might leverage something like a chain analysis.
The people that come to us, typically, they're looking for data so that they can make more money. Chain analysis and those folks or services like them, it's more around regulation, security, forensics. Someone stole my Bitcoin. Where did it go? Or, exchanges like Coinbase have purportedly used tools like that to make sure that, dirty money isn't getting into their wallet. So I honestly have very little visibility into people's forensic needs or needs for this data around regulatory purposes. It's more around making cash, generating returns.
As far as everything goes, I think we've covered quite a bit with the general topic of the kind of nonsense around cryptocurrency exchanges, how somebody can potentially protect themselves around the issues that are happening right now. Is there anything maybe we didn't cover you would like to just kind of add on to at this point?
I saw a tweet from Circle the other day. They were talking about the state of Poloniex when they purchased it. They had something like thousands upon thousands of open tickets when they purchased it.
190-something thousand.
It was like 190-something thousand. And I remember there was a point in 2017 where everyone was using Poloniex. I mean, at one point it was the top exchange. Yeah, it was a top dog. So to kind of be in a place where the top dog exchange has hundreds, 100,000 plus open tickets to a place now where the top exchanges that people are using have solid operations in place. They are answering their support tickets for the most part. It's really refreshing. And I think we're just in a very different place right now in 2017 than we were in 2019. And it's great to see real operators coming in. I think back in the day, it was like any project with someone with a vaguely impressive pedigree, was getting funded because VCs and investors really didn't know who to back at that time. So you'd see people where, you'd look at them and it'd be like, okay, Stanford computer science, X Airbnb, X Coinbase or something. And then you dig into it and you realize, all right, they were like an intern at Coinbase. They dropped out of Stanford and they were like a product manager at Airbnb for like 8 months or something like that. And like, how did that guy get funded? It's really great to see people with real experience, I think, building out companies. And I think the VC money is getting smarter. They're demanding roles on boards, which, there's this sort of hardcore bootstrapper part of me that's like, no, VCs shouldn't be on boards. But actually, my experience with VCs on boards is it makes for good governance. So the governance on these, on these companies is getting better. And I think that the space is just up leveling over and over and over again. I think we're still going to continue to we're going to be embarrassed over and again and again and again, just like we were embarrassed by the Bitwise report. I mean, the space was. It just keeps on getting better, and it's encouraging to see.
I'm on board with a lot of the things you said. I think there's a lot of good to be drawn from what's happened recently, and just a lot of general improvements. And I think a lot of that has just been kind of like societal pressure or like community pressure, which has been trying to cleanse out a lot of the bad actors. And that's been nice. Just because you feel a little bit better, about operating in the ecosystem. There's still a lot of issues where you look at and you're like, this is a weird place to work full time. But outside of that, it's I think still moving in the right direction. Hopefully not getting worse, at least, because for some points in time it couldn't get much worse.
It's less of an amateur hour environment than it used to be. Thank God. Well, that concludes my conversation with Rob Paone from the Crypto Bobby podcast. I hope you enjoyed it. Before you go, I want to mention that since we've started producing episodes at a much higher rate, we now have room for a few more sponsors. If you like the work we do and you would like to support this show, then a sponsorship might be a good fit for you. I can say from our own experience that Flippening sponsorships work. Each and every time we put out an episode of this podcast, we mention our own API. And to date, every single one of those advertisements has resulted in at least one customer. In fact, we would do these shows even if nobody else sponsored because of the business it brings to us. And over 80% of paying customers mention that they heard of us through our podcast. If you're interested in sponsoring the show, please hit us up at support@nomics.com. All right, that wraps up things for this week. Stay tuned for next week's episode. Until then, take care. That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.